Hello, this is Julius from Basic Financials. Today this video is going to be about accounting treatment of fixed assets and the difference between it with the accounts and capital allowances for taxation purposes. Now this applies if you're a sole trader with a business like that, or it could be if you're a limited company. The same thing applies, but I'm going to keep it simple, so I'm not going to go into the detailed rules of capital allowances. I just want to explain a little bit why, when, say you've got an accountant, you prepare your accounts, and you see a profit in your accounts, and you think, well, that's what I pay tax on. Now, it's reasonable to assume that, but there are several reasons why it might not be. The accounting profit could well be different to your taxable profit because of various adjustments that are made for taxation purposes. And the main or a very common reason for one of those adjustments is to do with fixed assets. Now, fixed assets, they're things you might buy for your business that are going to last for a while. So maybe more than, say, 2 or 3 years. For example, you might buy a van for your business. You wouldn't be putting that into motor expenses in your profit and loss account, and you wouldn't be doing that and writing it off for the year as an expense, because that wouldn't really reflect an accurate accounting position. What you'd want really to do is to show that expense over the period of time that your van is going to last. So, for example, let's say you buy this van for £10,000. In your accounts, as I say, you wouldn't want it in motor expenses £10,000 for the year. It would it will skew the results. Say you think it's going to last for, say, 4 years before you need to get another one. So what you might want to do is depreciate it over 4 years. There are various different ways of doing that. You could do, but then this is the reason to bear in mind, there are various different ways. So the tax rules want to try and standardise it so it's the same for everybody, so you can't pick and choose and decide your own rules. But for accounting purposes, you're trying to come to a figure that is correct for you and for what you think, and that could be different for somebody else. So say, as I say, 4 years, you could decide to make that over a straight line, they call it. So you would do £2,500 each year. So what would happen is you would put your purchase of your motor vehicle into fixed assets on your balance sheet, so it wouldn't touch your profit and loss account. So you'd have motor vehicles, £10,000. Say you bought it at the beginning of the year. So for the first year, you would show depreciation of £2,500 in your accounts. So at the end of the year, your profit and loss account would show depreciation £2,500 as an expense, and your net book value of your motor vehicle, you'd have a cost of £10,000, and the depreciation to date would be £2,500. So your net book value would be £7,500. Now, the following year, you would do another £2,500, so you'd have another expense in the following year of £2,500, and your net book value would be £5,000 because you'd have your £10,000 cost, and your accumulated depreciation would be the 2.5 from the first year plus the 2.5 from the second. So you'd have 5,000 accumulated depreciation. And eventually, after 4 years, you will have written it down to zero. And you would expect, maybe, because that's what you thought, you would be buying a new one by then. If you don't, and you're lucky and it lasts for longer than that, then fine, you've written it off and you've still got it. Now, but for taxation purposes, they try and standardise. HMRC wants you to standardise how everyone does it. Now, there's something called an annual investment allowance, which means that you can get up to, at the moment, it's £1 million worth of expenditure can go against your profit straight away. So in this example, in that year that you bought that van, your profit and loss account would show an expense of £2,500, but you will be able to claim all of that £10,000 as a tax deduction because it's within your £1 million annual investment allowance. So straight away you're going to find that if you were to look at your accounting profit, which has got £2,500 in the expenses for depreciation, that gets added back to the tax profit, but then £10,000 will come off for your annual investment allowance where you bought your vehicle. But next year you're going to find that your accounting profit has got £2,500 depreciation in there, but that gets added back and there won't be anything to claim because you've already claimed it all. So next year your accounting profit is going to be £2,500 less than your taxable profit, and the same for the next 2 years as well. Whereas in the first year you're going to find that your taxable profit is £7,500 less than your accounting profit. So that's a little example of why your taxable profit is not the same as your accounting profit. I hope that helps a little bit, and thank you very much for listening. Don't forget to subscribe and leave any comments in the box below, and I'll be back with you with another video soon. Thank you.